Hello everyone, welcome back to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us discuss today question number 5 from 2023 Managerial Accounting under Marginal Costing question. Assuming the cost structure and selling price remains the same in period 1 and 2. Find out profit volume ratio, fixed cost, break-even point for sale, profit when sales are rupees 2 lakh, sales required to earn a profit of rupees 40,000 and margin of safety at a profit of rupees 30,000. Variable cost in period 2. We need to find out. And sales and profit is given for the both the periods, that is first year 2 lakh 40 18,000, 2 lakh 80 26,000. Whenever the year profits are given, then we are using the formula in this situation is change in profit divided by change in sales. For PV ratio, all the ratios one shots I have done. If you have not watch that video. PV ratio is equals to change in profit divided by change in sales. So here change in profit. Second year minus first year. 26,000 minus change in profit 26,000 minus 18,000 divided by change in sales 2,80,000 minus 2,40,000. 26,000 minus 18,000 is 8,000. 2,80,000 minus 2,40,000, 40,000. Here we are finding the ratio, so into 100 you have to do. 8,000 divided by 40,000 into 100, 20. PV ratio is 20%. Yes. What is the next question? Next we have to find out the fixed cost. What is the formula of fixed cost? Fixed cost is equals to contribution minus profit. Contribution minus profit. Profit we know, right? Contribution we don't know. So first we have to find out the contribution. Contribution is equals to sales we know, sales into PV ratio. Sales into PV ratio. Contribution. What is the sales? Sales for the first year. First year sale is 2,40,000. 2,40,000 into PV ratio is 20%. And second year contribution is equal to second year sale is 2,80,000 into 20%. Let us calculate 2,40,000 into 20 by 100, 48,000 contribution. Second year contribution is 2,80,000 into 20 by 100, 56,000. Now fixed cost is equal to contribution we know. First year contribution is 48,000 minus first year profit is given. How much it is? First year profit is 18,000. 18,000. Fixed cost is 48,000 minus 18,000 is 30,000. Fixed cost, both the year you will get same. If you want, you can see this is first year. Second year, if you calculate, second year contribution is 56,000 minus second year profit is 26,000. 56 minus 26 is also 30. So always remember the fixed cost will come same for both the years because it is fixed cost. Let us calculate break even point for sale. Break even point for sale. First one we calculated PV ratio, then we calculated fixed cost. Now we are calculating break even in sales. Break even in sales formula is fixed cost divided by PV ratio. We know fixed cost is 30,000 divided by PV ratio is 20%. So BEP in sales is 30,000 divided by 0.20, 20%. It is 1,50,000 BEP in sales. 1,50,000. Fixed cost is 30,000 divided by 20% is PV ratio. 1,50,000 in BEP in sales. What is the next question? Next question is sales required to earn a profit of rupees 40,000. Desired sale is equal to, because we are calculating when profit is given, desired sale we are finding is equal to fixed cost plus desired profit divided by PV ratio. PV ratio. Fixed cost is how much? 30,000. Desired profit is given, that is 40,000 profit when sales are rupees 2 lakh. So that we will find out later. First we are finding the sales required to earn a profit of 40,000. So profit is 40,000. Then PV ratio is 20%. Calculate 30,000 plus 40,000 divided by 20%, 0.20. 3,50,000. What is the desired sale? To earn a profit of 40,000, you need to make a sale of 3,50,000. Now let us calculate profit when sales are rupees 2 lakh. So required profit. Required profit is equals to sales into PV ratio minus fixed cost. Sales is how much? It is given. Sales are 2 lakh. PV ratio is 20%, that is 0.20. Minus fixed cost is 30,000. Let us calculate. What is the sales? 2 lakh into 0.20 minus 30,000. 10,000. Required profit is 10,000. The next question is, we have calculated profit when sales are 2 lakh. Sales required to earn profit of 40,000. Margin of safety, profit divided by PV ratio. Margin of safety is given. Margin of safety formula is, two formulas are there. First formula is profit divided by PV ratio or actual sale minus BEP sales. BEP sales. This is the another formula. Here profit is given. So what is the profit? Profit is 30,000. PV ratio is 20%. Margin of safety is 30,000 divided by 20%. 1,50,000. 1,50,000. Then finally we have to find out the variable cost. What is the formula? Sales minus contribution. See, always remember this format. Sales less variable cost is contribution. Contribution less fixed cost is profit. So now we want contribution. What is the sale? First year it is 2,40,000, right? First year sale is 2,40,000. See, 2,40,000. 2,40,000 minus first year contribution is 48,000. 2,40,000 minus 48,000 is 1,92,000. Second year is 2,80,000 minus 56,000 is the second year contribution. 2,80,000 minus 56,000. 2,24,000. That's it. I hope you all understood. See, first what we have done, we have calculated PV ratio. PV ratio, when the 2 years profit is given, then we are taking the difference, that is change in profit divided by change in sales. So that we have divided, then multiplied with 100, we'll get percentage of PV ratio, because PV ratio is expressed in percentage. Fixed cost is equal to contribution minus profit. Because contribution we don't know, we know profit. We need to find out contribution first. Contribution is sales into PV ratio. Sales is given and PV ratio also given. For each year we are calculated separately. It is 48,000 and 56,000. Then fixed cost is contribution minus profit is fixed cost. Both the year fixed cost will come same. You can check. So then BEP in sales, fixed cost divided by PV ratio. Then we calculated desired sales. When profit is given, desired profit is given, fixed cost plus desired profit divided by PV ratio, then sales will be 3,50,000. When required profit, you need to find out when sales are given, we are multiplying sales with PV ratio minus fixed cost, then we will get required profit is 10,000. Margin of safety, when profit is given, we are using this formula, profit divided by PV ratio. Otherwise we will minus actual sales from the BEP sales. Variable cost is sales minus contribution. See, to find out the contribution, if you minus sales minus variable cost, we'll get contribution. The difference between these two is variable cost. So then minus fixed cost is profit. I hope you all understood. Thank you for watching. Have a great day.